You know what's interesting about market tops? They're loud. Everyone's talking. CNBC's running 24/7 coverage. Your neighbor's giving you stock tips at the barbecue. But bottoms? Bottoms are different. Bottoms are quiet. Eerily quiet. And right now, in the gold market, we're experiencing something I haven't seen in my entire career, analyzing precious metals. A silence so profound, so complete, that it's actually deafening if you know what to listen for. Let me paint you a picture of what's happening right now, because the mainstream financial media isn't going to tell you this story. They're too busy covering the latest tech stock rally or whatever cryptocurrency is trending on social media. But while everyone's distracted, something massive is unfolding in the gold market. Something that, when it finally breaks into public consciousness, is going to catch 99% of investors completely off guard. Central banks just accumulated over 1,045 tons of gold. Let me put that in perspective for you. That's not just a lot of gold. That's the continuation of a buying spree that's been accelerating for years now. The National Bank of Poland led the charge with 90 tons, but here's what's really fascinating. It wasn't just one or two countries. It was a broad, coordinated accumulation across dozens of central banks worldwide. And they're doing this quietly. No press releases, no fanfare, just steady, relentless buying. Now, you might be thinking, okay, central banks are buying gold, so what? They've always held gold. But that's where you'd be missing the bigger picture. Because what we're witnessing isn't normal central bank behavior. This is something fundamentally different. Central bank gold demand now accounts for more than 20% of total global demand. 20%. Just a few years ago, that number was around 10%. They've literally doubled their share of the market, and they're not slowing down. Think about what that means for a second. Central banks are the ultimate insiders. They have access to economic data before it's published. They sit in rooms where monetary policy decisions are made. They understand currency flows, debt dynamics, and geopolitical risks better than anyone on the planet. And right now, they're buying gold like their lives depend on it. What do they know that we don't? Here's where it gets really interesting. While central banks are accumulating, retail investors have largely checked out. Gold isn't trending on social media. There are no viral TikTok videos about gold investments. Your friends aren't texting you about gold prices. The sentiment indicators I track show retail interest at multi-year lows. And historically, that's exactly when the biggest moves happen. When nobody's paying attention. When the crowd has moved on to the next shiny object. I want to take you back to a moment in history that rhymes with what we're seeing today. It's 1970. Gold is still officially pegged at $35 an ounce under the Bretton Woods system. But behind the scenes, cracks are forming. France, under Charles de Gaulle, starts demanding physical gold in exchange for their dollar reserves. Other countries quietly follow suit. The U.S. gold reserves are draining. But if you were reading the newspapers in 1970, you wouldn't have known any of this. The financial press was focused on the stock market, on the space race, on everything except what was really happening in the monetary system. Then, in August 1971, Nixon closes the gold window. Bretton Woods collapses. And over the next 9 years, gold goes from $35 to $850. That's a 2,400% increase. But here's the key. The smart money was accumulating during the quiet period. While everyone else was distracted, they were positioning themselves for what they knew was coming. Fast forward to today, and we're seeing similar dynamics play out, but on a much larger scale. The global debt situation makes the 1970s look quaint by comparison. We're talking about debt levels that would have been unimaginable just a generation ago. And central banks are responding by doing what they've always done in times of monetary uncertainty. They're buying gold. But let's dig deeper into what's actually driving this accumulation, because it's not just one factor. It's a perfect storm of converging forces that are all pointing in the same direction. First, you have the de-dollarization trend. This isn't some conspiracy theory. This is documented policy from multiple countries. Russia, China, India, Brazil, South Africa, the BRICS nations are actively working to reduce their dependence on the US dollar for international trade. And what are they using as an alternative? Gold. The numbers tell the story. Cross-border gold flows have increased dramatically. Central banks in emerging markets are repatriating their gold from storage facilities in London and New York. They want physical possession. They want it in their own vaults, under their own control. That's not the behavior of institutions that are confident in the current monetary system. That's the behavior of institutions that are preparing for something. Then you have the supply side of the equation, which almost nobody is talking about. Gold mine production has essentially plateaued. We're not discovering major new deposits like we used to. The easy gold has been found. What's left requires going deeper, into more remote locations, at higher costs. And even when new deposits are found, it takes 10 to 15 years to bring a mine into production. There's no quick fix on the supply side. Meanwhile, demand is accelerating, not just from central banks, but from other sectors too. Technology companies need gold for electronics. The green energy transition requires gold for solar panels and electric vehicle components. Jewelry demand in Asia remains robust. And then you have investment demand, which is still relatively muted but could explode at any moment if sentiment shifts. This creates a fundamental imbalance. Supply is constrained. Demand is growing. And the largest, most sophisticated buyers in the market, central banks, are accumulating aggressively. In any other market, this would be front-page news. But in gold, it's happening in near silence. Let me tell you about something that happened recently that perfectly illustrates this dynamic. A major European pension fund, I can't name them, but they manage over $200 billion in assets, quietly allocated 5% of their portfolio to physical gold. Not gold ETFs, not gold mining stocks. Physical gold, stored in allocated accounts. When I asked their chief investment officer why, his answer was revealing. We're not trying to make money on gold. We're trying to preserve what we have when everything else fails. That's the mentality shift that's happening at the institutional level. Gold isn't being viewed as a speculative investment. It's being viewed as insurance, as a lifeboat, as the asset you want to own when the ship starts taking on water. And more institutions are coming to that conclusion. Now, here's something important I want to address because it's relevant to a lot of people watching this. If you're sitting on a substantial retirement account, let's say $100,000 or more in a 401k or IRA, you might be wondering how this applies to you. Because most retirement accounts don't give you the option to just go out and buy physical gold bars. But there is a way to get physical gold into your retirement account without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. You'll find it in the description below. It covers the mechanics, the custodians, the storage requirements, all of it. Worth checking out if you're thinking about adding some portfolio insurance. Anyway, let me get back to where this market is headed. Because here's what I think is about to happen, and why this silence is so significant. Markets move in cycles. There's accumulation, markup, distribution, and markdown. Right now, we're in the late stages of accumulation. The smart money is quietly building positions. The public isn't interested. Prices are consolidating. Volume is relatively low. But this phase doesn't last forever. Eventually, something triggers the next phase, the markup phase, and that's when prices start moving in a way that captures public attention. What could that trigger be? There are several candidates. It could be a currency crisis in a major economy. It could be a sovereign debt default. It could be a geopolitical event that shakes confidence in the existing monetary system. It could be inflation that proves more persistent than central banks anticipated. Or it could simply be a technical breakout that attracts momentum traders and creates a self-reinforcing rally. The specific trigger almost doesn't matter. What matters is that the setup is in place, the fundamentals are aligned, the smart money is positioned. And when that trigger comes, whatever it is, the move is going to be explosive. Because there's not a lot of gold available at current prices. The central banks have been absorbing supply. The mines can't increase production quickly. And if retail investors suddenly decide they want exposure to gold, where's that gold going to come from? This is where understanding market structure becomes crucial. Most people think of gold as this massive, liquid market where you can always buy or sell whatever quantity you want. But that's not really true. The physical gold market is actually quite small. Annual mine production is only about 3,000 tons. Total above-ground gold stocks are estimated at around 200,000 tons. But most of that is held by central banks, jewelry owners, and long-term holders who aren't selling. The amount of gold that's actually available for purchase at any given price is surprisingly limited. Now layer on top of that the paper gold market, the futures contracts, the ETFs, the unallocated accounts. There's far more paper gold than physical gold, and as long as everyone's content to trade paper claims, the system works fine. But what happens if people start demanding physical delivery? What happens if the trust in paper gold breaks down? We've seen glimpses of this during periods of stress, when premiums for physical gold spike above the paper price. But we've never seen a full-scale run on the physical market. If that happens, the price discovery mechanism could break in spectacular fashion. Let me give you a historical parallel that might help illustrate this. In the 1970s, there was a commodity called silver that experienced something similar. The Hunt brothers started accumulating massive amounts of physical silver. They took delivery, they stored it, they kept buying. And as they did, the available supply of physical silver shrank. Eventually, the price went parabolic, from around $6 an ounce to over $50 in just a few years. Now, I'm not saying gold is going to move like that. The markets are different, the circumstances are different, but the principle is the same. When physical supply gets tight and demand surges, prices can move in ways that seem impossible until they happen. And here's what keeps me up at night. The current gold price doesn't reflect any of this. Gold hit an all-time high around $2,787 per ounce recently, then consolidated back to the $2,600 level. That's a healthy consolidation after a strong move. But when you look at the fundamentals, the debt levels, the monetary expansion, the geopolitical tensions, the central bank buying, the current price seems almost absurdly low. It's like the market is pricing in a best-case scenario where everything works out perfectly, when the evidence suggests we're heading towards something very different. I want to talk about something that doesn't get enough attention, the relationship between gold and real interest rates. Traditionally, gold performs well when real interest rates, that's nominal rates minus inflation, are negative. Because if you're losing purchasing power holding cash or bonds, gold becomes more attractive as a store of value. Right now, real rates are positive in many developed markets. Central banks have raised rates aggressively to fight inflation, and yet gold has been performing well. That's unusual. That's telling us something. What it's telling us, I believe, is that the market is looking beyond the current rate environment and pricing in what comes next, because central banks are in an impossible position. They've raised rates to fight inflation, but those higher rates are making government debt service costs explode. At some point, they're going to have to choose between fighting inflation and keeping governments solvent. And history suggests they'll choose to keep governments solvent, which means rates will come back down, probably while inflation is still elevated. That's the recipe for negative real rates, and that's when gold really shines. But there's another factor at play that's even more fundamental: trust. The entire modern monetary system is based on trust. Trust that central banks will maintain the value of currencies. Trust that governments will honor their debts. Trust that the financial system is stable and secure. And that trust is eroding. You can see it in the central bank gold buying. You can see it in the rise of alternative currencies and payment systems. You can see it in the increasing polarization and dysfunction in major economies. When trust breaks down, people flee to tangible assets, and gold is the ultimate tangible asset. Let me share a conversation I had recently with a fund manager who's been in the business for 40 years. He told me something that stuck with me. He said, "In my career, I've seen a lot of market cycles. Bull markets, bear markets, crashes, recoveries. But I've never seen a setup quite like this. The imbalances are larger. The risks are more systemic. And the potential for a monetary reset is higher than at any point since World War II. If I'm wrong and everything muddles through, gold will probably just chop around and I'll have wasted some opportunity cost. But if I'm right, and we get any kind of monetary disruption, gold could be the difference between preserving wealth and losing everything. That's not a bet I'm willing to take." That's the mindset of sophisticated investors right now. They're not trying to get rich on gold. They're trying to not get poor on everything else. And that's a very different motivation than what drives typical bull markets. This isn't greed. This is fear. Rational, well-informed fear based on an honest assessment of the risks in the system. Now, let's talk about what this means for price targets, because I know that's what everyone wants to know. Where could gold go if this thesis plays out? Well, there are several ways to think about it. One approach is to look at gold's historical relationship to the money supply. If you adjust for the expansion in the monetary base since the last gold peak, you get a price target well above $3,000 per ounce. Some analysts put it closer to $5,000 or even higher. Another approach is to look at gold as a percentage of global financial assets. Right now, gold represents a tiny fraction of total financial wealth. If that percentage were to revert to historical averages, let alone increase beyond them, you'd need a much higher gold price to accommodate the capital flows. We're talking about trillions of dollars potentially moving into a market that produces only about $200 billion worth of gold annually. The math gets interesting very quickly. But here's what I think is the most important consideration. In a real monetary crisis, price targets become almost meaningless. Because the question isn't, how high will gold go in dollar terms? The question is, how much will the dollar decline in gold terms? Those sound like the same thing, but they're not. In one scenario, gold is appreciating. In the other, the currency is depreciating. And if we get a true loss of confidence in fiat currencies, the price of gold in those currencies could go to levels that seem absurd today. I'm not predicting hyperinflation or a complete collapse of the monetary system. I'm not saying we're going back to a gold standard tomorrow. But I am saying that the risks are elevated, the imbalances are severe, and the smart money is positioning for scenarios that most people aren't even considering. And in that environment, having some exposure to gold isn't speculation, it's prudence. Let me tell you about what happened in Turkey recently because it's a microcosm of what could happen on a larger scale. Turkey experienced significant currency devaluation. The lira lost a huge percentage of its value. And what did Turkish citizens do? They rushed to buy gold. Gold shops had lines around the block. Premiums for physical gold spiked. People were converting their savings into gold as fast as they could because they understood that their currency was losing purchasing power in real time. Now, Turkey is a relatively small economy, but the dynamics are the same everywhere. When people lose faith in their currency, they turn to gold. And here's the thing, it doesn't take everyone to turn to gold for the price to move dramatically. Because of the supply constraints I mentioned earlier, even a modest increase in investment demand can have an outsized impact on price. If just 1% of global financial assets were to shift into gold, we're talking about a demand surge that would dwarf annual mine production. The market simply couldn't absorb that kind of buying without a massive price adjustment. This is why the silence is so significant. This is why the lack of retail interest is actually bullish. Because when the crowd finally wakes up to what's happening, when gold starts making headlines again, when your neighbor starts asking you about gold investments, the easy money will already have been made. The accumulation phase will be over. We'll be in the markup phase, where prices are rising but the risk-reward is less favorable. Right now, we're in that sweet spot where the fundamentals are aligned, the smart money is accumulating but the public hasn't caught on yet. That window doesn't stay open forever. And based on what I'm seeing, the central bank buying, the supply constraints, the monetary dynamics, the geopolitical tensions, I think that window is starting to close. Let me address something that skeptics often bring up. Gold doesn't pay interest or dividends. It just sits there. Why would I own it? And that's a fair question. In normal times, when the financial system is stable and currencies are maintaining their value, gold is indeed a low-return asset. You're giving up the yield you could earn on bonds or the growth potential of stocks. But we're not in normal times. We're in a period where the real return on bonds, after inflation, is questionable at best, where stock valuations are stretched by historical standards, where the risks in the financial system are elevated. In that environment, gold's lack of yield isn't a bug. It's a feature. Because gold doesn't have counterparty risk. It can't default. It can't be inflated away. It just is. There's a saying in the gold market, gold is the asset you hope goes down in value because if it's going up, it means everything else is going wrong. And there's truth to that. Nobody wants a monetary crisis. Nobody wants a financial system collapse. But hoping for the best while preparing for the worst is just common sense. And right now, the cost of that preparation, the cost of owning some gold, is relatively low compared to the potential benefit if things go sideways. I want to talk about one more thing before we wrap up, and that's the psychological aspect of this market. Because markets aren't just about fundamentals and technicals, they're about human behavior, fear and greed, confidence and panic. And right now, we're in a very unusual psychological state. There's complacency in the broader markets, confidence that central banks have everything under control, faith that the system is resilient. But underneath that surface calm, there's anxiety. People sense that something isn't quite right. They see the debt levels. They feel the inflation. They watch the geopolitical tensions. And they're quietly taking steps to protect themselves, even if they're not talking about it publicly. That's what this silence represents. It's not apathy. It's preparation. The smart money isn't making noise because they don't want to tip their hand. They don't want to drive prices up before they've finished accumulating. They're happy to let the public stay distracted while they build their positions. But at some point, the accumulation will be complete. The trigger will come, and the silence will break. When that happens, the move is going to be fast. violent even, because that's how markets work when they've been coiled up for a long time. The longer the consolidation, the more explosive the breakout. And gold has been consolidating for years now, building energy, waiting for the catalyst. All the pieces are in place. The central banks are positioned. The supply is tight. The monetary conditions are favorable. The geopolitical backdrop is supportive. We're just waiting for the match to light the fuse. So what should you do with this information? Well, that's a personal decision that depends on your individual circumstances, your risk tolerance, your investment timeline. I'm not here to give you specific financial advice, but I will say this. If you don't have any exposure to gold right now, it might be worth considering, not as a speculation, not as a get-rich-quick scheme, but as insurance, as a hedge against the risks that are building in the system, as a way to preserve purchasing power if the monetary environment deteriorates. And if you do decide to add some gold exposure, think carefully about how you do it. Physical gold has advantages: no counterparty risk, true ownership, privacy. But it also has disadvantages: storage costs, insurance, liquidity concerns. Gold ETFs are convenient and liquid, but you're trusting the fund structure and you don't have direct ownership of the metal. Gold mining stocks offer leverage to the gold price, but they come with company-specific risks and operational challenges. There's no perfect solution. It's about finding the approach that makes sense for your situation. The bottom line is this: we're in the silence before the storm, the calm before the chaos, the accumulation before the markup. And if history is any guide, the investors who position themselves during the quiet periods are the ones who profit during the loud ones. The central banks understand this. The sophisticated institutions understand this, and now you understand it too. The question is, what are you going to do about it? Are you going to wait until gold is making headlines and everyone's talking about it? Or are you going to act while the opportunity is still available? Because I can tell you from experience, the best trades are the ones that feel uncomfortable at the time, the ones where you're going against the crowd, the ones where you're buying when nobody else wants to. And right now, with gold consolidating, with retail interest low, with the mainstream media focused elsewhere, this is one of those moments. The storm is coming. The silence won't last forever, and when it breaks, you'll either be positioned for what comes next, or you'll be scrambling to catch up with everyone else. The choice is yours. But don't say you weren't warned. The signs are all there. The smart money is moving. The fundamentals are aligned, and the clock is ticking. This is the silence before the gold storm. And storms, by their very nature, don't stay silent for long.